Thank you, thank you. Thank you, Thorsten. All right, this wonderful lady next to me here is also working at Handelsblatt, where she's a tech correspondent. I was reading with fascination about the new deep tech investor. The biggest in Europe is here in Germany.
Yeah, it's V squared. It's really, good news for Germany. I think it's
That's the last thing
that we have money for deep tech.
Absolutely, and that's the last thing you wrote about.
Yeah.
But tell us something you haven't written about. What's the news on Flix? Are they IPOing this year or not?
Probably not. No, EQT is going to take a stake, and probably they're going to delay their IPO. That's at least what we heard and what we wrote about in Handelsblatt today.
So if you're curious about who's IPOing and who's not, and about the VC landscape in 2024, we have got genuinely a great lineup. Yeah. We're so thankful that you're here to be the moderator for that.
Yeah.
So with no further ado, ladies and gentlemen, please give it up for the wonderful panelists as they come up on stage.
And now they should come up on stage. Here we go. So there aren't any names anymore, but I'm going to introduce them. That's Carsten Salling from Dreamcraft. We have Helene Ametsreiter from Speedinvest and Florian Heinemann, who's already sitting from Project A. So I'm going to sit down. Great to have you here on stage. I really like this panel and this lineup. Probably everyone here knows Florian and Helene. But there's a new face on the stage, and that's Carsten. Maybe you could just start introducing yourself and where you come from, what you're investing in, stuff like that.
Yes, I will. Thanks a lot for inviting me, first and foremost. So I'm Carsten Salling, one of the general partners at Dreamcraft Ventures, Copenhagen-based early-stage venture fund, focused on B2B software investments in the Nordics and in Germany. We are currently investing out of our 66 million euro Fund 2. Already made 14 investments out of that, in addition to the 20 portfolio companies we had in Fund 2, of which 8 is actually investments in German companies, where we have co-invested with the likes of 10x, Picus, 42Cap. Some of them are here. I'm sure we will soon have a co-investment with either of the two over here as well. Let's see.
Deals. We're lining that up. Helene, I mean, I think everyone knows you here, but maybe, no, not everyone? Okay, but it's me. I know you. You're from Speedinvest. Maybe you can tell us about, the companies you've already invested in. There are quite a few, but just tell us a few names.
Well, in total, we have 350 investments, so quite a big portfolio, being a pre-seed seed investor. But some of the likes you might know is WeFox, Wayflyer, Tier Mobility. So that actually are also kind of the value drivers of the portfolio. As you know, a few will return the fund, hopefully. So, yeah.
Florian. Maybe you could just tell us a bit more about Project A and especially what you're interested in right now.
Yeah. Project A is also an early stage fund. We're based in Berlin and London. We currently invest out of the fourth fund all over Europe. We're roughly 30% DACH, 20-25% UK. Nordics is also one of the main areas, and then the rest is rest of Europe. We typically try to have like 80% of the portfolio from 4 areas right now. That's resilience tech, so that includes defense or dual use, fintech, so companies like Trade Republic or Liquid are the portfolio. Then we look at climate and energy, but if you look at climate energy, it's mainly software solutions in there, so we are explicitly not too keen on hardware. Not because it's bad companies, but it's you always have to fit it into one fund, and typically I think mixing different types of models in one fund often doesn't make that much sense. And the fourth area we look at is basically the reconfiguration of global supply chains. So obviously with decoupling and China, US, etc., you have a lot of states of array in global supply chains, and there are tools, companies, software needed to support that, and that's a fourth area, but we are a generalist fund, yeah, so we're agnostic, but probably 80-85% of what we'll do will come from those four areas.
I mean, over the last years, we've seen a rise in venture capital around the world, at least. Not so much in Germany, or we're just not that mature yet. But what do you think? How can we copy this rise in venture capital? What is needed in Germany for that? Yeah, just start.
Yeah. I think if you look at the number of startups that we see, that has definitely developed in a great way. And I think if you kind of dissect what you see on the overall kind of venture capital statistics, yes, we are currently declining, yeah, but if you look on top line, but I think if you look below the surface, there's a lot of things happening in early stage, so that's not declining, that's very healthy. What has been declining is more the later stage rounds, yeah, and we are coming from 2020 and 2021 numbers, where you can also ask yourself whether that has been a healthy state, yeah, because I think what we always have to consider is good companies need to be able to get money with decent effort from decent investors. And I think that is definitely, if you compare to 15 years ago, we're in a much better shape today. Yeah? So if you are a good company and if you have a clear differentiation, you'll get money. Is it always from German investors or European investors? That's a different story. Yeah. Whether that needs to be a case, also we can discuss. But I think overall, the state of the ecosystem has definitely developed. What we need more, and I think that's a good thing, you see that at Unternehmertum or whatever, you know, creating more technically grounded startups that will develop. I think that's more probably in the European nature and also fits our ecosystem better than any B2C place. I mean, there will be some B2C plays, no? That's fine. But I think the majority needs to come from this engineering, deeper tech type background, because I think that's where we have a strength. We still have a lot of industrial kind of companies here that can support there. So I think we're not in such a bad shape, yeah, in terms of the companies that are currently being created. I think the bigger problem is more, you know, can these companies then develop here well in terms of regulation? Are we attractive enough for the best talent globally to come here? I think those are questions that we have to ask ourselves. But I think the venture capital availability has definitely improved a lot. Yeah. So, yeah.
I mean, that still leaves the question, what happens at a later stage? But yeah, definitely that maybe we could just make it up to the equation. We need more startups, and then the money will come.
The money will come.
So, yeah.
Unfortunately, the government cannot just say, startups, be created. That doesn't work. Yeah? They need to create themselves. So we just can create basically an environment where that works.
Yeah.
Well, I think we need liquidity. And in order to trigger the cycle that is then spinning to become bigger and bigger. As long as we cannot produce good exits in Europe, that money would usually, you know, flow in again into, is it funds, SLPs, or is it investments into startups? And this is true, I mean, the exits you can produce, of course, via IPO, so stimulation of the IPO market. On the other hand, also towards strategic exits, something that I feel we see ways too little. Still, we have the Mittelstand, we have the big corporations, we have a very, very healthy industrial arena here. And if you look at the big techs in the US, they, you know, procure some 150 companies and startups, absorb a year, that creates liquidity.
Yeah. Do you agree, Carsten?
Yeah, 100%. I think one of the biggest challenges we have right now in the European ecosystem, and we see it in the Nordics as well, is the lack of exits. Yeah. Because it is, the VC asset class is super cyclical, but it's also a super flywheel. And for that flywheel to spin, you need exits to basically recycle talent and capital into the ecosystem. And in the Nordics, the current kind of cohort of really interesting early stage companies is in many cases coming from the talent that has pursued other opportunities after a successful ride Supercell in Helsinki, Spotify in Stockholm, Unity in Copenhagen, and we need some exits to basically set the next cohort off. And I'm really looking forward to see that happening. Some promising signs of funds being closed in the Nordics ourselves last week, and Creandum Fund 7, 500 million fund.
Yeah.
That's really, really good news for the early stage system. We still lack the exits. One was announced this week with Be Real being acquired by Voodoo. I know it's in France, but this is still another good sign. And another positive sign for me on the exit side is the launch of Stepstone's dedicated secondary fund, 3 billion, which is, to my knowledge, the largest globally, to help VCs getting liquidity.
At least from my opinion, venture capitalists don't really like to talk about secondaries, but there are more secondaries. We are seeing them everywhere because, well, as we already mentioned, there are no IPOs or like only a little, and probably also not much merger and acquisitions. So is that something you do as well? I know Speedinvest has some dedicated people working on secondaries, but does it help to gain some liquidity over the course of a fund?
Definitely. I mean, the situation that we see at the moment is in it that you have the value drivers within your portfolio that need to defend at the moment their valuations that are really in a tricky situation at the same time trying to prove long-term sustainable growth, but focusing also on profitability. That's a complete reshake. So you really need to very much focus on those guys and help them and support them. But at the same time, we as VC, we have a lot of pressure from our LPs that finally want to see some money returned, because, I mean, the vintage funds that were like 2011, 12, 13, they have gone through this hyper cycle where you have exploding NAVs on paper and valuation on paper, and they now see that declining and they want to get their money out. So, of course, with this pressure, we are trying to create exits and some distributions with also secondary funds that become more popular, meaning that you sell off part of your portfolio. Usually it's a bundle of companies at a discount from the book value, and then they would more or less get into those. It's a lot of negotiation, a lot of, as there is no public market to know what's really the price tag, this changes from day to day, so it's not an easy exercise to do.
I can only imagine. Do you do that as well at Project A?
Yeah. I mean, it's. I think one of the biggest problems in the asset class is illiquidity. Yeah. I mean, the one thing is you need to make decent returns that have enough distance to the public market return. Yeah, because otherwise it doesn't make any sense to put money into VC if you're not beating the MSCI World by at least. It's a philosophical discussion by how much, but you have to beat it significantly to justify the illiquidity of the asset class. So providing more liquidity, and you see that in private equity. I mean, in private equity, in some years, the secondary market is bigger than the primary market. So, and if you look at how many big institutionals are investing, how much of their AUMs into private equity, I mean, technically, VC is just a subclass of private equity, but if you look at like buyout, traditional private equity, I mean, the one reason why it's also so much larger than VC is also the degree of illiquidity in the VC market. So if you can reduce the degree of illiquidity as an industry, that helps. On the other hand, the guys have a big advantage to us. We are very hit-driven. Yeah? So you shouldn't sell your hits too early because, I mean, the VCs can basically say, if you make a 3x, it's fine. Yeah? If we would, sell a 3x, a winning company at a 3x valuation in a secondary, that would be a huge mistake. Because every early stage VC has 50% loss ratio, roughly. I mean, some have 40, some have 60. But the main thing is you need the hits, And the hits take time. I mean, if you look at, for example, Creandum with Spotify, I think it took them 15 years to sell off the position. And that's a long time. But if they wouldn't have waited those 15 years, the fund would have looked not so... Although this fund would have looked great regardless, because I think it also had Klarna and Adyen in it.
Yeah, it was
but the typical fund has like one great company or two. So if you sell the great company too early, I mean, you can partially sell it.
Exactly.
But that's the tricky thing, yeah? How much should you sell? How much? And you really see this market developing now in Europe, and I think that's a good thing because it will help us to get more money into the market, hopefully. But I think what we need, and I think you announced it, we need also for the big exits, which only will work if there's an IPO in Amsterdam or an IPO in Paris or an IPO in Frankfurt or in London. Let's say UK is still part, or at least of Europe.
Yeah.
You need more larger tech exits at those capital markets. And I think if there's one thing politics can probably accelerate or should focus on, it's like creating good environment, getting best talent in, enabling the best universities to create great spin-offs, and trying to take care of a more tech-friendly capital market. Yeah? And trying to support that. And that will probably not work by having one in Amsterdam, having one in Paris, having one in wherever. Yeah? You need to bundle the volume, and you need to, I think, bundle the expertise. And I think until that happens, we have a systematic disadvantage. And we'll always have a certain tendency of the best companies to go IPO in the US. Yeah? That's the fact. Which still we still can return our money. I mean, that's fine. But if you want more tech also being kind of headquartered here, the center of gravitas here, you need a functioning tech-friendly capital market.
Yeah, I mean, at the beginning of this panel, I was talking about Flix and that they are, delaying their IPO again and maybe probably already taking other direction. So they are not the only one, but they were like the hopeful candidate, and now they're not there anymore. So,
And let's see whether they will choose Frankfurt or New York. Yeah. I mean, they have Greyhound. Yeah, they're US.
Well known over there.
Consumer brand.
Yeah.
And look at Birkenstock. I mean, it's probably the most German company. It's not a tech company. It's probably the most German company you think about. But they're listed at New York.
Yeah.
Given the administration and legislation efforts that you have for an IPO here versus US, there is a good reason.
Yeah. I mean, we've already talked about the problems you as VCs have. The lack of IPOs, the illiquidity in the market. So everyone, or like especially experts, were wondering, are we going to see more mergers in VC? We had the news of General Catalyst and La Familia, so that really raised some headlines I think it was last year. So is that a solution? Can that be a solution, or do you just think that probably the smaller funds are going to die down?
I'm happy to start. It's a very straightforward yes. I think we're going to see more mergers and a consolidation of the market, especially for the early stage funds that don't have a track record. It's very hard at the moment to fundraise the second or third fund. And therefore, I think that's the only opportunity, in a way, they have. So, also, I have to admit, I think it's good, a good thing to happen, that there is kind of a cleanup, because in the long run, venture capital definitely as an asset class will remain and will stay.
Yeah.
I mean, no, go ahead.
I can only echo that, and I think. One of the other challenges I see is in the ecosystem, a lot of tourist VCs has come in, tourist investors in general.
Yeah.
And some will leave through M&A, some will simply not raise their next fund. And I think that's a good thing, because there will be some of these tourists who are not performing well enough, who are not behaving well enough. And that's not good for the asset class, especially not at this point in time, where we need many more entrepreneurs building new companies. We need many more LPs investing into the VC asset class. So the sooner we can get more exits and less tourists, the better.
But on the other hand, we definitely need continuous flow of emerging managers, because they keep the industry fresh. And
fresh as we need.
That's quite funny, because we always ask our founders, where is your innovation, and what's your right to play, and how is it defendable? And then if you ask most VCs, it's actually quite funny. The answers that you get are not so convincing. So I think it's good that and that has already improved a lot, because there have been so many more players in the industry that also VCs now have to think about what's our differentiation, how can we specialize, how can we really add value, and that's a good thing. And I think a continuous flow of emerging managers helps. On the other hand, it's a scale game. I mean, if you have professional fundraising activities, and if you're just thinking about fund setup and the regulation also with ESG you have to fulfill, if you are a 10 million fund, it's very, very hard to operate it in a sensible kind of way, because it's just getting, from the operating cost, it's getting harder and harder. So I think that's also one reason why there's consolidation. And if you look at the large AUM gathering platforms like a Partners Group or EQT or whatever, on the private equity side of things, you see, I mean, that's kind of, I don't know whether the VC market's heading in that way, but they're all multi-asset, they're all multi-manager, they all share a common platform. So there's a certain logic to that also from scale advantages that you have.
Yeah, that could be a solution, at least for a few. We are running out of time. I've already, that was someone who told me that we should hurry up. I have one very short question for all of you. Maybe you could just answer in one sentence, because we are here at Hinterland of Things, and I mean, it's a conference for startups and founders. So if there is a founder out there who would like to know if you could get money from Speedinvest or Project A or Dreamcraft, what are you interested in, Carsten? So who should approach you, and probably who not?
So we invest super early stage, where it's all about the team, and we are called Dreamcraft because we invest in these founding teams that has the right mix of dreamers and crafters. So that will be what I would focus on. Reach out to Dreamcraft if you believe you have the right diversity in your team, because you will need both dreamers and crafters along the way, that's for sure.
Okay. What about you?
So as we are, and I missed that out in the beginning, we are investing in 6 different sectors. So I think almost every one of you, feel free to approach me. But in the end, we're
just line up.
an operational VC, and we are a partner that you should reach out if you don't need just money, but really someone also that helps you with network, that helps you to grow your company and be connected to a broad network Europe-wide.
Just to echo that, probably, I mentioned the 4 areas already. So if you're a seed, pre-seed, founder, maybe also Series A in those 4 areas, reach out to us. If you're headquartered in Europe and you have extremely ambitious plans that ideally are somehow software or data, somehow technology-based. So we're not just doing execution-focused companies. Done a lot of that in my past, so I think I'm pretty good at distinguishing that from actual technological kind of differentiation.
Awesome. So you know what you're doing next, and we are heading off stage. So thanks a lot, and enjoy the rest of the conference.
Thank you.